All right, good morning, trade pros. Welcome to our morning market update for this beautiful Wednesday, June the 17th. Hope you guys had a great day. It is Wednesday, and so it means that we have oil inventory. All right, it's going to be a big day. It's going to be exciting, and there's some action around the markets as well overnight. Let's talk about this a little bit more. Let me get a sip of coffee first. Good news is, my barber is reopening next week. He called me and he said, "How are you doing?" I said, "Cutting my own hair." He goes, "You're gonna make me lose my job." I said, "No, man, I'd pay you double now, knowing how crappy it is to cut your own hair." All right, so anywho, let's get in the markets. Today we're gonna get another version of Jerome Powell. So Powell yesterday spoke, Powell part 1. Today we're gonna have Powell part 2. He is back in Congress today, this time in front of the House Financial Services panel at 12 p.m. EST. Okay, so 12 p.m. Eastern. In his testimony yesterday, Jerome Powell said some interesting stuff. He gave a pretty cautious outlook overall for how the U.S. economy is looking, some cautious forecasts as well. He said that a significant improvement in the employment situation may still leave the labor market well short of levels seen before the pandemic shutdown. So even though he's optimistic enough for some kind of recovery, he is not optimistic enough to think we're going to get back to where we started before the pandemic. All right, coming from a Fed chair that's, it's a pretty bearish outlook on the economy, saying, it's not going to get back to where it is. It's also pretty realistic. I don't think we'll ever get back to where we were. I think things will be a little bit different going forward for some time. All right, and so interestingly enough, though, that puts the Fed in a situation where they say, look, we don't think the economy is going to get back to pre-pandemic levels in terms of the jobs market. That puts us in a position to be able to stimulate and to justify giving some more assistance to the stock market in the form of liquidity, all right, printing money and circulating it, buying corporate bonds now. All right, not only are they buying corporate grade bonds, they're buying bonds of the companies directly. And so the Fed is in the stock market, more or less. Right, it's in the bond market at the moment, but it's not that far of a stretch. Next pandemic, next dip, next kind of mini crisis or scare, heck, maybe even a 10% drop from here triggers the Fed to say, hey, we're buying stocks. We don't really know anymore. The Fed's kind of acting really aggressive. And so here's the thing. In addition to Jerome Powell speaking, Federal Reserve Vice Chairman Richard Clarida, so he's the vice chair, second in command to Powell, in a separate speech yesterday kind of said the same thing as Jerome Powell. He said that he warns the economic damage may threaten the stability of inflation expectations. Okay, think about that. When these Fed speakers talk, try to understand what they're really saying, because the way Fed speakers are trained to talk is to have an idea over here of what they're actually doing. This is their monetary policy, and to mix it and twist it and blend it and send it to you out here in the media to kind of confuse you. So like, what are they doing? I don't get it. Listen to this. He warns the economic damage may threaten, this is the most important part right here, the stability of inflation expectations. Up until now, the Federal Reserve has had to justify why cutting rates, why providing more stimulus is needed, all right? And they've done it by saying low inflation. But what Clarita's saying here is, even if inflation jacks up and skyrockets temporarily, overshoots, they may not abandon their accommodative stimulus. That's very, very important. To me, that's a clear sign of a separation from the Fed having a mandate to just being support the market as a mandate officially. The interesting things, watch for Jerome Powell. There's a lot of depth to this. I could talk about his speech yesterday to Congress for a long time. I had to read it. I couldn't actually listen to it. But there's another one coming up at 12 p.m. The remarks are prepared. They're going to be the exact same, identical to yesterday. The Q&A will cause the volatility. All right, look out for that 12 p.m. Yesterday, retail sales, which is a measure of purchases at stores and restaurants and online, rose a seasonally adjusted increase of 17.7% in May from a month earlier. That's a big jump. All right, people are spending more. They're not spending more. They are buying more items, but those items are less. All right. The increases were driven by spending on motor vehicles, which represents a fifth of the retail sales. Furniture and apparel sectors also posted strong gains. Those make sense. Right? If you're working from home more, you're going to need a different set of wardrobe to work from home. Right? Ain't nobody out here working in a suit and tie at home. Even investment bankers are probably doing calls with, like, I don't know, little Hello Kitty T-shirts. I didn't have a good example there. All right, but there's a big boost in retail sales month over month, the strongest monthly jump dating back to 1992. All right, but still down 6.1% from a year earlier. So retail sales have recovered quite strongly from this pandemic. People are spending money once again. Where are they getting this money from? 7 a.m. we had a report that's saying mortgage applications, all right, are up 8%. The expectation was 9.3 based on the prior number. So there are people filing for less mortgages than prior. However, you get this, the refinance index is at 3,891 versus 3,529. A lot of people are refinancing their homes. All right. We've also seen that consumers don't really hold as much debt as we thought, and retail sales are rebounding. On a consumer level, that's pretty strong. I think that the problem here is on a business level post-corona pandemic. That's the real impact here. And if businesses at a business level, things are impacted, that trickles down to consumer eventually. So, we're in a very interesting time right now. In Asia, Japan's down 0.6%. Hong Kong's up the same 0.6. China's up 0.2. India down 0.3%. In Europe, at midday, London's up 0.6. Paris up 1%. Frankfurt down 0.5%. All right, and in the U.S., Dow and the SPOOs, the S&P up 0.4. Nasdaq up 0.5, leading the way a little bit stronger overnight, but now kind of dumping as well. All right, since about 8:14 this morning, we've seen a little bit of downside. All right, on the economic calendar, we talked about mortgage applications. Housing starts disappointed the market this morning around 8:30. All right, we were looking for a number of 1.095 new housing starting projects, right? New development, and we got 0.974, so it missed. All right, the prior number was 0.891 or 891,000, still higher than the prior number, but it was kind of a disappointing outlook. So home builders aren't really planning to start new construction projects. Then take a look at these stocks like Home Depot, Lowe's, etc., that are being impacted from this. All right, month over month, we had the housing starts go positive on a percentage basis, but still on a total number, they're down a significant amount, didn't grow as much as expected. That's a leading indicator for the most part, and it didn't come out too hot this morning. It's not enough to make the S&P drop 100 points, but pay attention because eventually a couple of these indicators will have some effect on it. All right, at 10:30 this morning, we have the oil inventories from Department of Energy and the IEA, the International Energy Association, has released their demand report. And they've actually said that in 2021, they expect a huge recovery in demand. But it ain't 2021 yet. And so that's too far out. Who knows? But that report came out this morning. We have crude oil inventories as well today at 10:30. So we have a lot of opportunity in the markets. 12 p.m., Powell testifies. 1 p.m., 17 billion 20-year bond auction. 4 p.m., Fed's master. Wishes that was the name. Fed's Mester will be speaking at the response to COVID-19. All right, we got a few things on the calendar and on the docket. Watch 10:30 off the open for oil. There isn't really any huge economic updates until then. And I think below prior day close levels on the S&P 500 futures, 31.16.5, you're going to see some downside open up. All right, let's see what we got in store today. We're near the prior day close and the 5-day point of control. We could see some sideways action, but I do think today we open to the downside. So I'm looking initially for a bearish push lower and looking to get on board on a rally within that bearish move. All right, you guys have a great day. Love you all. Be good. Happy to be back. I skipped yesterday. I think Vicky did a fantastic job. Watched the morning market update. And so I thank him for stepping in and helping out. Well, Craig, we can do a whole webinar on that. It has changed, Craig. Your trading style would have to change from pre to post COVID-19 to be taking some advantage of that. Maybe we'll do a Q&A session soon on YouTube, Craig. And you could ask that question. I'll give you a little bit more depth on it. It's going to be a long-winded answer. There's a lot to it. Okay, pretty much a lot's changed. When are you doing the Q&A on this Saturday? Not this Saturday, Red. Let's do it next Saturday. Are you good with that? If it works for you, Craig, you too. YouTube, love you guys. Let's call it a day. Love, joy, and happiness for family. We'll do the Q&A soon, I promise you. And I just can't do it this weekend. You guys have a great rest of your day. Manage your risk, TRADEPRO. I got to open up the trade room. Take care. Goodbye. Ciao.